This is our Forex blog for February 29th, 2012. And like we do most days, we want to buy the strongest currency versus the weak. We want to sell the weakest versus the strong. The more time frames that line up, the better. On the top, we have the dollar and the yen, and we compare every currency to every other currency on multiple time frames using multiple tools. We then average it together to give you a very easy to read indicator. The top one shows the bar by bar statistical strength or weakness. You can see with the dollar, when you have a lot of weakness followed by less strength, usually that trend continues to the downside. You can see the same pattern. The weakness for about 30 minutes and almost no strength, the weakness continues. Underneath that, we have a daily, weekly, and monthly trend, which is made up of 3 different tools which are averaged together to give a more accurate and quick tool that will change the daily, weekly, monthly trend as fast as possible while keeping it in the same direction as long as the trend continues. If you have all time frames lined up like the dollar, it's more likely to go down. If there's weakness today, but the daily trend's up, the weekly trend's up, it's less likely to continue in that direction for as long. In other words, you're likely to make less pips if you trade on that signal. The Australian and New Zealand are clearly the strongest of all the currencies. The CAD started to show some strength, but like I was just saying, the daily, weekly trend and monthly trend are slightly down. Daily trend shifts up. You can still trade real time. You can even completely take off the daily, weekly, monthly trend, especially if you're a scalper or you like to hold trades for 30 minutes to 2 hours. It becomes less important. I mainly use the longer term trends, especially the monthly, to determine how many lots to trade. And I will take bigger bets and bigger gambles on currencies where all the time frames line up, and I'll trade less aggressively on currencies such as the pound, where it's showing mostly strength today. The daily trend is very strong. The weekly trend, you can see, switched up, but the monthly trend's down. I will trade a little bit less than my normal trade size if that's the case, because it's not likely to continue up as long. And you can see strength here, weakness for an hour. Guess what? The strength only lasted for 30 minutes and you had weakness. And then after that, you only had 15 minutes of strength here and about an hour of weakness. And then after that, the strength pretty much went up for many hours. But again, if you're going against, especially the weekly trend in the middle, you're more likely to get up, down, up, down, up, down moves. Whereas if you trade in currencies like the Australian and New Zealand, where they're all the time frames are up, you have strength, pretty much from midnight all the way until about 10. With mild 15 to 20 minute pullbacks, 20-minute pullbacks, 20-minute pullbacks, 5 minutes of mild weakness, 15 minutes here, and so forth. Again, stack the odds in your favor. That's what the whole point of this tool is for. So the euro's weak, but the weekly trend was up. The monthly trend is, however, slightly up. But you can, again, like I said in the beginning, you can still focus mainly on this and trade the weakest one. It was weak. The Australian and New Zealand in CAD were strong earlier today, so you could sell the weak euro versus those other currencies. I don't leave those running like I do most of the other ones. So let's take a look at the Euro Australian. Guess what? Trend was down. Euro New Zealand, trend was down. Euro CAD, trend was also down. And again, the CAD stayed strong after 10, whereas these other ones really, kind of lost their strength. That's why this one just continued. It fell another 100 pips after that point. And you really never know which one is going to pick up and become in the future the weakest. So if you trade a bunch of currencies, small risk per trade, 1 or 2% of your account on any given trade, basically here's some of the trades I would take on this one. It was weak, it went sideways here. This is our sideways rectangle pattern sell. You get short, you're looking for a pullback. That's the preferred trade. If this trade had gone up maybe like this, as soon as it broke that trend line plotted underneath the bar's lows, you'd go short. In this case, it didn't. I don't know if I would have taken that trade there. This is a little bit of a pullback right here, and this is ideally what I'm looking for. Decent size, 15 to 25, sometimes 30 pip pullback. And when a trend line gets broken simply because the currency is going sideways, I do not enter. I repeat, I would not have gone short here. But I'm starting to look for shorts. When I see it kind of go sideways like that, and it breaks underneath those sideways bars low, then I would get short right here. And it's possible, let's zoom in on it by hitting the plus key. It's very possible that I would have gone short when it went a pip below these bars low, which it did. Short at 91, stop up here at 04. I would have got stopped out and had to re-enter this trade here. The key to trading is just small losses, bigger wins. And when you use a currency meter, in my opinion, you should experience a higher winning percentage than you would have without it. And you also tend to catch more of these big moves. Now, most of our traders on any given day consider 20 to 50 pips a big move. This is kind of an obscenely big move where it just kept going and going. Whenever you get a big win like this, if it goes sideways, you might want to exit half your trade, move your stop above these bars high, and most of the time you're going to get stopped out with a little bit less on the second half. In this case, it continued. What I always do on these kind of big moves when they happen, I'm lucky enough to be trading at the time where they happen, is draw my fibs on there, and rarely do currencies go beyond the 1.618. So on the second half of this move, when it kind of went down here, I'm watching it. If it would have kept going down another 10, 20 pips, first sign of it going up maybe 5 pips, I would exit the whole thing, because the majority of the time, you occasionally get more than 1.618, but you can see it just went a few measly pips underneath here, about 6 pips, and then reversed, and then kind of went sideways. So don't be greedy when it comes to those patterns. All right, so the CAD, Australian, and New Zealand are strong. The dollar and the yen were also weak today for most of the time. So you can trade those. Buy the Australian dollar, buy the Australian yen, buy the New Zealand dollar, sell the dollar CAD, and buy the CAD yen. So let's take a look at some of those. Australian dollar, currency's above the hourly. It went up a lot, and it's kind of going sideways here. This is another perfect example of our rectangle pattern. I personally would not have taken this trade just because this is one of my Fibonacci profit targets levels right here. The actual number is right in the middle of it. I add a little padding above and below. So if I would have bought this breakout here at 24, I only have a 12 pip profit target. I don't really want to risk 10 or 12 pips to only make 12 pips. So for that reason, I probably myself wouldn't have taken it. But once it rallied up here with a lot of strength, pulled back, and found support. This was the monthly pivot level. We have the previous week's high. Once the resistance level gets broken and it comes back down to it and acts as support like this, it's usually going to try to get back up to the highs. So the second one, because it broke the resistance area for the first time, I probably would have bought the second one here. And it wasn't nearly as good a trade as the first one. It went sideways right here, and I would have only made 6 or 10 pips on it. But let's take a look at some of the other ones. Australian yen. This one's a little bit better trade because it's not already up near the upper containment bands. The upper containment bands, usually, we call them containment bands for a reason. They tend to contain price, as you see here and here. If you scroll back and look at it yesterday, look, contain price, contain price. There's a reason why we call it the containment bands. They really work, and they're based on the maximum volatility over the last 20 years in our proprietary algorithm that uses that maximum volatility. But nonetheless, this is an excellent place to exit your profit. This one had a narrow range pattern, broke out last night. It's always a good idea to buy a breakout of the narrow range high if it's above the hourly. You don't want to sell a breakdown of the narrow range pattern if it's above the hourly. So in other words, you're only selling breakdowns of narrow range patterns if it's below the hourly and you're only buying it from above. But the fact that it had a narrow range pattern here and it trended up so nicely, when it pulled back to the hourly and found support, again, support areas when holding are a good place to buy. And you can see the second trade right here went from about 80 all the way up to 35.40. That was a huge win. You might have exited the trade here when it hit the previous day's high, and then when it breaks out here again, you get back in again, maybe make another 10 or 15 pips. And later in the day, the currency also found support at the hourly. This is also our Elliott two-wave fib system in action. When the currency makes a nice size move up, typically, and especially when it's at our upper containment band, typically we'll make a two-wave pullback. So here's the first wave, you draw your fibs, and you want to buy somewhere between the first and second fib target. So this one kind of went sideways at the hourly and the first fib target. When it breaks out right here, you go long. And in all honesty, I would have probably got out of half here when it hit the previous day's high and couldn't break it, then get stopped out with a small loss in the second half. When it went sideways right here and broke out again, I would have got back in it. And usually I'm not really greedy when a currency's already made a move earlier. I'm kind of expecting it to not work. I probably would have just got out of the second trade here at 26. I would have been at 07. So that's about 19 pips on the second half. I might have, with the small loss and the small win, maybe made 2 or 3 pips on the first one and 20-something on the second one. But, you know, small losses, big wins. Once you get into a trade and you're trailing stop moves, your initial risk, which might be 10 or 12 pips, usually quickly, dissolves into maybe only a 5 or 7 pip loss if the trade doesn't work. So your losses are most of the time, if you're trading properly, less than what you initially budgeted for. That's a nice word. You're budgeting for a certain loss, and a lot of times your loss is less than you expected. And that makes trading easier because you will frequently find wins bigger than you expected as well. So you have smaller losses and bigger wins, and that allows you to trade well once you learn our trading methods.